Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, August 20, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And as you can see, we're flirting with the recent highs from just about a week and a half ago. These are not the all-time highs, but we're not really that far off from the all-time highs. While we're talking about that, let's just put it in perspective. And here are the all-time highs. And I can squeeze together the chart just so you can get a better look at it in a second. But the all-time high in the Spider's 286.63. And right now, to put it in perspective, today's high happens to be 285.97. So we're less than $1 away from all-time highs in the SPY. The same holds true from the other indices, meaning the S&P 500, the cash market, and others. So we're at highs. NASDAQ's at highs. IWM's doing well. The Dow is near highs, not at a high. We may take a look at the Dow just to put it in perspective as well. But let's talk about where we are in relation to where we've been and what the expectations should be. So we had a little shimmy down last week. And each and every time there's a shimmy down, and I'm talking about we had a down day on the 9th, we were down on the 10th, the 11th, up on the 12th, and down on the 13th. Pardon me, there was a weekend in there, down on the 15th. And each and every time the market goes down, the bears come out of the woodwork and they start talking about a correction, a crash, 20% down, 10% down, the market's topped out, all this stuff. And so far, and eventually someday it will be true, but so far none of it's true. And the point that I've been trying to get across for a long, long time, and not just days and not just weeks, but it's really months and even years in a lot of cases, is that we have to not pay attention to and learn to ignore the news media. They don't know what they're talking about. It's generally, and what they're reporting by it, when I mean it's generally after the fact, okay? And so when you hear, bear market sentiment, it's after the market's already been down 2 or 3 days. And there's nothing wrong with the market being down 2 or 3 days. Look at this, for example. And this is something absolutely 100% without a shadow of a doubt right out of my course at Lazy E Mini Trader. If you look at the recent pivot top, not today, but before today, the recent pivot top down to the recent pivot bottom, what you'll find is a specific period of time that the market went in a trend for. And I teach this in my course at Lazy E Mini Trader, how to identify and why the market will trade for a specific period of time, how to identify when a trend is about to begin, when a trend may be ending, where to take profits during a trend, when to jump on a trend early, and when to exit a trend when the trend is about to change, meaning you sell into strength, you buy into weakness. Those are the things that I teach in my course at Lazy E Mini Trader. And generally speaking, and it's really sad to say, but unfortunately it's true, it's sad to say that most traders, most investors, frankly, most people just do the wrong thing at the wrong time the majority of the time. And it's really sad to see. I've been doing this a long, long time, and I've seen way, way too much of that. And it's one of the main reasons why I do some of the things that I do, is because I don't want to see that. I want to see people be able to make money in the markets. And with that said, let me pause there because it's a perfect segue into thanking everybody for participating, making comments under the video, participating with your very valuable insight into markets, into the economy, into any topic you folks want to talk about. I appreciate everybody's participation. It's helpful to me. It's helpful to the entire community. We're trying to pay it forward here, so I thank everybody for doing so. In addition, please hit the like button on the video and share the video with those people you think can benefit from this information. All right, so where are we in relation to the spiders? Are we going to keep going higher? S&P 500, are we going to keep going higher? As it stands right now, the trend is your friend until the very end. And I know it sounds like it's very easy just to say, yeah, of course we're going higher. The trend is up and we're going higher, and that's very obvious, and everybody should know that. But the reality is, and those of you that have been around for a while know, that I was the one also saying we're going higher when we were in downtrends along the way, saying it was just a pullback. The market topped out here, we're going down here, and I say it's just a pullback. This is a buying opportunity in here. Another one, pullback, buying opportunity. And I said it on the day. On this day right here, on the 2nd of August, I said that's a big time day. We're going to use that low to trade against. What is that low? That low happens to be 279.16. What's the horizontal trend line on the screen? 279.16. When the market came down the other day and it made this low on the 15th, not quite 279.16, but it was about $1 away. We were $1 away. Do you think I would have been buying closer to risk had we got down toward $279? Yes, I would have. You want to buy as close to risk as you can. And what does that mean, buy close to risk? If I believe that a certain area is going to be supportive of the market, in this hypothetical example, well, it's not hypothetical, but in this example, 279.16 on the spider, last week we started coming down toward 279.16. I know that if we got a daily close below 279.16, that was going to be trouble, and still would be today, trouble for the market. So therefore, if I can buy it near that price, slightly above 279.16. If I can buy close to, again, quote unquote risk, meaning my risk is a close below 279.16. I want to buy close to there because my risk is small. If I have to lose and the market goes the opposite direction from what I thought, I'm going to lose small and fast. That's the objective that's taught in the course at Lazy E-mini Trader, how to lose small and fast. Listen, we're going to have to lose on certain trades. We just can't win 100% of the time. But with me, what's going to happen is, A, you're going to be right the majority of the time. B, you're going to know the chart setups, the pattern setups on these charts, whether it's a 10-minute, 60-minute, daily, weekly, monthly. Doesn't make any difference whether it's a short-term trade for 15 minutes or 20 minutes or 30 minutes, or whether it's a swing trade for a day, 3 days, a week or two. It doesn't make any difference. All charts act and react the same way, and what you traders learn in my course is how to identify the high probability patterns that play out over and over and over again, and when those patterns fail, how to identify the failure very quickly, allowing us or enabling us to lose small and fast when we have to lose at all. And that's the name of the game. Lose small and fast, capitalize as much as possible, build our account size, grow the account, compound the account over and over and over again. Net on the spider, the trend is your friend. Higher prices are coming. We still have higher prices coming in this market. Don't be surprised, and I'm going to use a number that you haven't heard me talk about before, but when we talk about the S&P, we talk about the spider, it's 285.67. Fine. We talk about the S&P 500, which we don't really throw out the numbers that much, but it's really a fraction of, it's 1/10 of. The spider is $285, and the S&P 500 is $2,857. So it's roughly a 10 multiple. And don't be surprised on this rally. Now, it's not going to happen all in one bite, and we may have to have 2 or 3 pullbacks along the way, but don't be surprised if the S&P 500 reaches 2,900 on this rally. It's really not that far away. It's only 43 points away, pardon me. It's only, oh yeah, I am right, 43 points away from where we closed on Monday, the 20th of August. The S&P 500 is 2857. 2,900 is not out of the cards. It's a big fat round number. If we did get up to that number, we'll have to take some action there. We'll talk about it if we approach that number. On the downside, we do have to talk about both sides of the market. So we have to talk about the alternative. What happens if we wake up tomorrow morning and the S&P 500 or S&P futures are down 30 or 40 handles and it's going to be an ugly gap down lower day? Where are those breakpoints? Where is that line in the sand? Couple of important things that we need to note. Number one is the 20-period moving average. Getting below the daily 20-period moving average right now comes in at 283 and a quarter. Getting below that, even intraday, would be a warning sign. But below that, we have a gap. And the gap happens to be 282.38. So that would be an area where the market would likely find at minimum of intraday support. The 20-period moving average, and then 282.38. There's a gap there. Also, the same day, the 15th, the low of that day, any close below the low of that day, that would be trouble for the market. And then, of course, back to the same number discussed before, 279.16. Closing daily below that number would also be trouble for the market. Again, these are what ifs. I'm not suggesting, nor am I forecasting, that any of those things on the bear side is going to happen. Right now, the trend is our friend, and until the very end, we stay with the trend and we try and ride it for as long and as far as we can. Now, here's a chart of the IWM. As you know, this is my favorite market leading indicator on the up and the downside. The IWM finished on the day slightly ahead of the SPY in percentage terms, but not enough to really make too much out of it, so we'll leave it alone. But there is something more important on this chart. What's more important on this chart is the same thing we've been talking about for quite a while. So the one thing that we've been discussing is this breakdown candle. The high is 168.72. Those of you already know, those of you that have been around a while already know where I'm going with this. But we had a down move and we had a bearish wedge pattern. And I've been discussing this for days and days and days. And I said, one of two things has to happen. Either this bearish wedge pattern plays out to the downside. They made an attempt the other day, but we reversed trend. Or the IWM is going to close a day above the high of the breakdown candle. Here's the breakdown candle. The high of the breakdown candle was 168.72. The close today was 168.82 by 10 cents. Now, that's not an accident and it's not a coincidence. Now, you'll notice here that the IWM on the last 10-minute candle of the day, which was a heavier volume candle than all the rest, 1.2 million shares against average during the day of, let's say, less than 300,000 shares. In fact, a lot less than that on most of the candles. So you see, on the heaviest candle of the day, they could have easily pushed it down to the 50-period moving average on the 10-minute chart, which would have pushed it down below the number. It would have pushed it down below that important daily number, closing high or closing number of 168.72. But they chose not to. In my world, there's no accidents, there's no coincidences. Nothing happens because it wasn't intended to happen. That's the way I approach the markets. So I'm looking at that and saying that's a positive sign for the IWM. We may get a trick, trap, fool, and frustrate. We may get a dip back below that number. We may get a dip back below there for a few days. We've seen that, and we've read that book before. We've been to that movie. We even have the t-shirt from a number of times that those things happen. But guess what? We've seen it in the spiders on the weekly chart. We've seen it in a number of charts, and we're going to pay very keen attention to this because it's important. I pointed out each and every time it happens, it doesn't work 100% of the time, but the majority of the time, it's a smoke signal, if anything else. It's the market's way of indicating to us that higher prices are likely coming. The transports, my second favorite market leading indicator. Now, the transports had a nice big healthy up day today, up 134 points, over 1%. Now, we've been talking about the transports getting close to the former high. Couldn't get through the former high. We pulled back a little bit, but we stayed above the moving averages. Even on the weekly chart, we showed last week a couple of times how we were a lot ahead or far way ahead of the weekly moving averages. We had nothing to worry about from a technical perspective on these charts. So if I bring up a weekly chart of the transports, you'll remember that we said we have a lot of white space between the weekly 20-period moving average and where we were. So we can afford to pull back if we had to all the way to the 20-week moving average and have no technical damage done to the chart of the transports. Well, guess what? Didn't matter anyway. The transports are going higher. Again, my second favorite market leading indicator. So now let's look at this for a second. My first favorite or my single favorite market leading indicator, the IWM, is giving us a signal that higher prices are coming. Not many analysts or people would even pick up on what I showed you, and these are the type of things that are taught in my course. I give you stuff that nobody's ever heard of before, and that's the way you find success in the market. Not using indicators that 9 million people are using that they sell for $99. That's not the way you make money in the market. You make money by knowing stuff that most people don't know about. That's how you make money in the market. So my second favorite market leading indicator, the transports, are also making highs. They're making a run for the former highs. Look where we are. Here's the weekly chart. We're making a run for the all-time high at 11,423. Now that's important. Are we going to get through those highs? Most likely we will. Do we have to get through them on the first run? We may or may not. I don't know that we will or we won't. But the likely story is that ultimately we will get through those old highs. Here's a chart of the Qs. Now what's interesting with the Qs is that the Qs were basically flat today. If I look at the NASDAQ composite, it was flat. It was up less than 0.1%. The Dow was up 0.33%. The S&P was up 0.25%. The transports were up over 1%. The XBD, or the Financials Broker Dealer Index, was up 0.5%. So interestingly enough, that the Qs were basically flat, and part of that has to do with Amazon was down again, Apple was down a couple of bucks, Facebook was down $1, but there was other stuff that was up healthy. You know, Netflix was up $11, Google was up, Baidu was up, Baba was up. So there was plenty of stuff up. So it's interesting. We still have that quandary here that we need to be aware of. Again, looking at both sides of the market. I'm not biased one way or the other. I may look at a chart and tell you that it looks bullish. That's fine. I may look at another chart and say, hey, this doesn't really look bullish. On the short term, it looks like there's trouble ahead. On the short term, it looks like unless this 20-period moving average on the daily chart holds, and we're teetering right now, then there's probably lower prices ahead. We have the makings of a lower high. Now, there is a couple of things going on, and, you know, you can make a case both ways. Number one is we just talked about closing above the high of a breakdown candle, right? So we did that here. So we already did that. So is that a sign or a signal of higher prices to come? First, we have the trick, trap, fool, and frustrate. So maybe we're just pulling back, and maybe there's another leg higher in the Qs. That's totally and legitimately possible, and that could be happening. But in order for that to happen, we still have to really get going on the upside, and we're threatening near all-time highs in all these markets, but they all have to be in sync together. They're not going to just go one at a time and leave other ones behind. You know how I always say, it's unlikely the market makes new highs, for example, or challenges the old highs without participation from the financials. Well, the financials ended up getting off the mat, ended up rallying, and it allowed the rest of the markets to participate on the upside. Well, the same thing goes for the Qs. It's unlikely we're going to see the Qs selling off 1, 2, 3, 4, 5% and having the S&P and the Dow and other markets rally in the face of that. It's just not likely. It's just unlikely to happen that way. So either something has to give one way or the other. Either the Qs are going to catch up on the upside and start looking a little better from a visual chart perspective. And if we get back above, and you know, today we closed, we'll just call it on the 20-period moving average. If we get back above the 20 and we start going sideways and inching our way, grinding our way higher, that's okay. Nothing wrong with that. We can certainly have a pickup in activity that way. But if we start failing at the 20-period moving average here on the daily chart, that's going to be trouble. They're going to want to go for the 50-period moving average, and then they're going to want to go for this breakup candle low. And if that doesn't hold, that's going to be trouble. Now, again, I'm not suggesting that's going to happen. I'm saying if. It's just an if. I'm bullish the markets, but when I look at a chart like this, I can't help but have to look at both sides of the equation. I can see both cases. I can see an up move. I can see a pullback pattern. I can see this being a bullish wedge pattern, setting up, building energy for another move higher. I can certainly see that without a shadow of a doubt, but I start to get concerned when the 20-period moving average doesn't hold. I start to get concerned when the NASDAQ market, which has risk assets within it, I see the IWM doing okay, and I don't see the NASDAQ market, which has money destined for risk assets. When I don't see that money participating, it's telling me that there's not a full-fledged run to risk, and that has me a little bit concerned. At least I have an antenna up. That's it. Looking at the broker-dealer index real quick, and the reason why we look at this, just as stated before, without the financials, and there's the broker-dealer index and also the XLF, two separate baskets of financial-related stocks. Without the financials, the market is unlikely to stage a significant rally to the upside. And also, we use the financials as a proxy because if they're melting away for some reason and the major markets haven't followed suit just yet, they do act as a proxy or an leading indicator of what likely can happen. So in this case, we see the financials ended up, or at least the broker-dealers, ended up making a nice double bottom in this area here and have since rallied off that area, trying to get above the moving averages. So no trouble in the short term with the XBD. So they've actually found support, which is good news for the bullish case of the XBD. And when you look over at the XLF, we know the story there. We have two different stories going on. We have one on the short term while we wait for the chart to populate here. One on the short term, which is we can see higher prices, but in the longer term, when you go to the longer term chart, for example, the weekly chart, we see how even if we do go higher, we can run into a pretty heavy level of overhead resistance slightly higher. So you can see here on the weekly chart, we have a breakdown candle, and the high of that breakdown candle happens to be 29.10. So you can see on the weekly chart, it appears that we've been making bullish consolidation going sideways above these moving averages, building energy for another push higher. The question is that next push higher in the XLF going to be enough energy to get us through and to close a week above 29.10? If in fact we do close a week above 29.10, that would be very bullish for the XLF and then translate into bullishness across other markets as well. We'll have to see how that all shapes out, but right now 29.10 would be very, very important from a weekly closing standpoint, Friday's close. Looking at the daily chart, there's nothing wrong with the daily chart. We're still above all the moving averages. We did take a dip down last week, but we popped right back up above. That is a sign of strength, shows somewhat of buoyancy in this market. So again, the XLF and the XBD seem to be okay from a short-term perspective. The SMH, also another proxy for the technology sector. Now, here's an interesting chart because, again, we have to look at both sides of the tape. The SMH doesn't really look that healthy overall. So you have the SMH, which is the proxy or the exchange-traded fund that tracks the Philadelphia Semiconductor Index. Look where it is. We're below all the moving averages on the daily chart, and we could be making sideways consolidation, which means even if we traded up toward the moving averages and we just grinded our way higher up, $2, $3, $4 in the SMH, that doesn't mean that it's not building a bearish pattern that would be building energy to be released to the downside for another leg down all the way down to this area here in the 97 camp. So that would be the next area of major support for the SMH. But that's also $5, give or take, away from where we are now. So just call it, for argument's sake, and don't split hairs over fractions, call it 5%. Are we going to go up 5% from here and repair the damage that's done and get above the moving averages? Or are we going to go down 5% from here and complete what looks like a weak chart pattern? It's interesting. This chart looks like one and by itself. It doesn't look like most of the other charts. So we have to take it at face value. I'm telling you what I see. I see, if anything, a downward bias in the SMH. Now, flipping over to the gold market, we finally have another seemingly, or what seems to be, a potential bottom in place. Now, I got a ton of emails from traders, and that's fine. I appreciate everybody paying attention, identifying where the trade may be taking place. You're all right. Everybody is correct. We do have something to trade against right now. And when it occurred on the 16th, we had a bottoming tail put in place, and that is the day, or that is the number. That bottom is what we can trade against. We can trade against the low of $1,167 spot 10 in the gold market. A lot of traders jumped on the bandwagon. This was something, again, right out of the Lazy E-mini Trader course. It couldn't have been any more clear. So all the traders that took that trade, and that was really taken sometime on the 17th, which was Friday, traders were in that trade based on either a partial retracement or just the fact that they had something to trade against. We got follow through today. So those traders that have been and still are long gold, number one, protect your profits. Have pocketed some profits along the way, and you can let the rest run in what's known as a risk-free opportunity. And also just know where the trade is wrong. It's wrong with a daily close below the low from the 16th of last week, which happens to be, once again, 1167 spot 10. Kudos to everybody jumping on that trade. Crude oil. So in crude oil, nothing really going on good for crude oil. You can see here now we're hovering down where we filled the gap last week. And now we're making, once again, or another bearish wedge pattern. These will have a tendency to turn back down, finish in the other direction. So you can see we're really in now a counter trend type of bounce or rally off the lows. And now we're hovering above the 200 period moving average. So when we look at the 200 period moving average on the daily chart, and we see that we came somewhat close, relatively close, now we're bouncing away from it. The more we bounce away from it and the longer we bounce sideways and higher away from the 200 period moving average, if we were to come back down, the less likely we would be to play as a long trade the 200 period moving average, because the longer we hover over or consolidate over a price, the less likely we want that price as a potential trade. If price were to come into a certain area in a straight shot from a long distance away, we're more likely to have, as long as we feel that that's a legitimate support area, something that would normally be a support area. So in this hypothetical example, we have to predispose that we have what should be a likely support area. If price comes from afar, on the first shot, our odds are very good that we're going to get that price reaction in the other direction. This is one of the things that I teach in the Lazy Gap Trader course. But when price hovers over a certain area for a period of time and then goes into a target, that's not the same trade as price coming from afar. So when we get back to this chart of the CL contract or the crude oil contract, the longer we consolidate over this 200 period moving average, the less likely we would be apt to buy that 200 period for a long trade. Right now, I would say we would have at best a 50-50 shot, and I don't really want a 50-50 shot. I think we can get better odds than that on a lot of trades. But the longer we go sideways above it, the worse the odds actually become that 200 period moving average becomes supportive of the market. Now keep in mind, I went through that whole rendition about the 200 period moving average, consolidation, price coming from afar, all that stuff. I went over that based on the chart we're looking at, but that's a lesson that can be applied to any chart, any time frame, whether we're looking at an intraday 10-minute chart of AT&T, or we're looking at a chart of gold, or we're looking at a weekly chart of the S&P 500. It doesn't matter. It makes no difference. All charts act and react the same way. So when I see something on the chart and decide to turn it into somewhat of a verbal lesson, I'm looking at a specific vehicle, in this case crude oil, but I'm thinking in terms of it makes no difference what the vehicle is. This is just a lesson that if we see something like this occur on a different chart, another time frame, it's something we can be aware of and helpful to us into the future. And with that, folks, my voice is going. I'm out of wind. I'm going to wrap it here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.